Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending November 4th, 2022. Sorry for a bit of delay to get this video out, but wanted to go over the market, go over the economic numbers, and give you an understanding of what's happening right now in both of those aspects, the market as well as the economy as a whole. Now this week I'm going to title the video "Markets Tell the Real Story About Jobs," and this is a great lesson in how you should kind of ignore the headlines that you're going to see on TV, read on websites, etc., and pay more attention to the market reaction. And we're going to get into why the market reacted the way it did. Now, the first economic data for the week was the Chicago PMI. That came in once again below 50. So the second consecutive month of, remember, anything below 50 is shrinkage. And you've had 2 months in a row where the Chicago PMIs are down. And then you follow on Tuesday with the broad US ISM manufacturing PMI, and that hit 50.2. So basically stall speed, right? And the lowest level since the beginning of the pandemic, or at least coming out of the pandemic, right? So May was the last time it was this low of 2020. And then it's always interesting to not just look at that headline number, but also some of the other factors that are reported. One is the prices paid index. Obviously, that feeds into inflation, and that decelerated once again to 46.6, and that's showing deflation. It's below 50. So on the manufacturing side, and we've said this before, this is the transition from the consumption of physical goods, manufactured goods, versus services. And so shouldn't be a surprise to anyone to see the manufacturing side of the economy slowing much faster than the services side, because there's still a lot of pent-up demand on the services side, whereas there was the opposite, pull forward demand during the pandemic of manufactured goods. So to see that weakness should not be a surprise. Now, the services PMI, that came in at 54.4, a deceleration, but still growing, still decent, right? But kind of the lowest levels once again since the pandemic started. And then you look at employment index, that was at 49.1, so slight shrinkage there, and that feeds into our story a little bit later that we'll talk about jobs. But the services prices paid index, now that had a bit of an acceleration, not to new highs or anything, but a bit of an increase, which, remember, most of the economy is services. So this is what mainly is going to feed into the CPI number that's going to come out. I believe that's next week or the week after. And certainly the market's going to react to that because that's going to feed into Fed policy, et cetera. But this was not a great sign for that, but overall, it's lagging as well. So the deceleration you saw in services prices over the past 2 months, actually 5 months, is going to continue to feed into the CPI index. So that was probably the most negative when it comes to potentially the Fed slowing down or pausing. Now, Friday, you got the non-farm payrolls, and this is where you get into those headlines. And the headline, 261,000 jobs, which looks like is the lowest level. Geez, really, since the pandemic. You're seeing a theme here, right? The lowest level in job creation since the start of the pandemic. This is always an anomaly. This is negative 20 million, so it's always hard to see on this chart. But the market acted like, oh, well, that was a beat. The expectation was in the high 100,000s, I believe it was. And the market didn't react like that. You would think that strong jobs number would say, okay, the Fed's not going to pause. They're going to do 75 again in December. And this is a strong indication for that. But if you look under the hood and you look on the market reaction, that's not what you saw. And we'll dig into that in a second. But unemployment rate did tick up from 3.5 to 3.7. Average hourly earnings decelerated year over year to 4.73, the lowest level since August of 2021. And then recession probability, that came out on Monday. That ticked down a bit, but still elevated. I still expect a mild recession, but something that isn't like '08. Everyone fights the last war, and they think a recession is '08, and it's unlikely to be. And I thought this was a good blog article, and it talked about the details within the jobs picture. And while the headline talks about job growth, it's anything but. So there's the BLS report. the Bureau of Labor Statistics, and that's a different report that uses different methodology, and typically it's more accurate. And in fact, employment fell in October by 328,000. And that's what the market was reacting to. The market wasn't reacting to 261,000 jobs created. The market was reacting to employment falling, and not just all types of employment, full-time employment down 500. Look at this, 572,000 jobs since May, and that's really when the economy started to really decelerate. So don't just look at the headline number. Look at other statistics that the market likes to, or the market is going to pay attention to. And now the positives were there were some revisions to employment over August and September, about 29,000 total, but minor compared to the, once again, 572,000 jobs lost since May. And if you look at full-time employment, here it is, down 433,000. All right, and average weekly hours, flat, 34.5, and then same with private services provided, that was flat, 33.5 as well. Manufacturing ticked up a tiny bit. But overall, you're seeing a picture of a weakening labor market. And that's really what the market was reacting to. U6 unemployment was higher at 6.7%, from 6.7 to 6.8%, and then, it would have been higher, but a lot of people dropped out of the labor force over the past few years. We know that. And this blog article talks a bit about tech and finance layoffs, and I completely agree. I think that's what you're seeing most of the layoffs. It's not really in the services side of the economy. I think that's why you're still seeing relative inflation there, your hotel workers and restaurant workers. I don't think it's really there. It's more in the tech side and layoffs within the mortgage industry, for example, and then the tech industry, which the Pelotons of the world, and then now Twitter, a bunch of layoffs there as well. So, this is an area that you're going to see most of the pain within the labor market, and that's what the market was reacting to. And you can see going over to the CME, the Fed watcher, we're past the November meeting, right? We just had it last week. We knew 75 basis points, and they kind of gave a mixed picture of what December is going to be. And on Thursday, you had a 61% chance of 50%. And then this actually went up. Oh, there we go. Oh, this was yesterday, so a week ago, this was at 48. Now it's at 52. So actually not a whole lot of gyrations here. Still kind of that 50-50 mark between 50 and 75 for for December. Yeah, I guess that would be next month now. So let's dig into the charts here and talk about the market reaction, because that's always most important. Now, the S&P, that was positive on Friday, but you had mostly a down week after the Fed meeting, right? Here's the Wednesday when the Fed met. Their original release was very dovish, talking about pausing at some point, but then the press conference kind of gave a mixed bag, saying that, maybe we still might do 75 in December, and the market didn't like that, sold off, but we didn't go to new lows or anything, right? It was just a kind of weekly low, still not below the lows from the last week of October, and overall, this was a modestly down week for the S&P. But if you dig into like the NYSE, let's go to the NYSE, obviously one of the most broad indices, 2,500 different names, that was fairly down for the week, right? You look at the Russell, let's go to the Russell. Did we get a flat week? That was still down as well, but it was much more muted than what you're seeing in like the NASDAQ. And that had a rough week. Amazon continued to follow through to the downside after the bad earnings report on Friday, last Friday. Google, that one had more follow through to the downside. Meta remained weak overall after their bad week last week. So, this is just a picture where the rotation from growth to value continues. And this was a week where you saw a another stair step down, where a lot of the value sectors continue to do well, and the tech sectors, here's XLK having a rough week. SMH overall, actually not that bad of a week, to be honest with you. But just tech in general, and mainly software. You do like SKYY, that had a rough week. This is the cloud software ETF. It's always a good one to follow. But you're just seeing that continued rotation out of growth and into value. Let's look at some of those other sectors, those value sectors. So here is energy just powering to new highs. You have industrials going above the 200-day moving average for the first time since August. That's certainly a positive for the economy as a whole. And now basic materials, which had been kind of on, making lower lows here, is starting to make some headway. Closed pretty much at the highs of the week, above the 100-day moving average. So the material sector, and part of this is potentially could be reopening in China, dropping the zero COVID policy. That was a rumor that over the week that was going to shift, and that's certainly going to help the material space, more demand for raw commodities and energy. So you saw that strength as well. So you continue to see that rotation. Now the VIX, that was another tell on Friday. You had the market down, not Friday, Wednesday on the Fed meeting. You had the market down pretty dramatically on the Fed press conference, and the VIX was flat. And then you had another down day on Thursday, and the VIX was down. Think about that. VIX was down on a pretty bad day for markets overall. So that was a tell that, hey, this probably isn't going to go into some sort of big drawdown in equities. People are positioned as well very negatively in the market. And when that happens, it's hard to have big down days or down weeks. So, those are some tells to say that these lows are probably going to hold at least for some time. Now, it doesn't mean they're going to be the ultimate lows, but they certainly could be. Now, the SHY, that one that was up on the jobs report. You would think, once again, the headline saying, hey, the Fed's going to be more hawkish. That's not what you're seeing in the bond market. The SHY, short-term rates were down, so the SHY was up. J&K to the IEF. So this is, remember, I like ratios. Ratios are really nice to look at. This is junk bonds to treasuries, and junk bonds remain strong. It's just showing that this is not likely to be a bad recession. And I'm sure the Fed is looking at that and is happy to see this hold up overall. And let's look at the dollar. Another reaction that you wouldn't expect. The dollar was down. This whole time, over the past month, really since the September Fed meeting, the dollar is roughly flat, even though the Fed has gotten more hawkish. That's very interesting to watch, and it just shows you if that can just pause, you're going to see commodities really take off. And that's what's happening. Here's DBC. Look at DBC, the commodities tracking index, just taking off to the upside. So all types of commodities certainly ready for another move higher on the fact that the dollar is likely pausing and potentially pulling back more significantly, but we shall see about that. Now, gold had a rough week to start with, but finished the week very strong on the highs of the week and closing above the 50-day moving average for the first time really since August. And if you do the silver to gold ratio, the silver also did very well, and that continued to break out to the upside. So these tells that gold was near kind of a longer term, or at least a medium term bottom, continue to play out, and silver just mooned today to the upside. So definitely very interesting to watch on that front. And then lastly, I want to get to, let's go to the GDXJ to the GDX. That one also had a nice week, especially over the last couple of days. Remember, the junior miners outperforming the regular miners. That's certainly bullish for the sector overall. So very interesting week. Ignore the headlines. Pay attention to what the market is telling you. And remember that everyone's positioned bearishly. It's very bearish over the past month, especially early October. And when everyone's positioned one way, it's unlikely for that to come to fruition. Now, the pendulum is likely to swing the other way at some point. We'll probably get overbought, and everyone kind of forgets about the risks that are in the market and the coming recession and the problems with higher rates, and that brings longer term, and the lagged effect of monetary policy. So just because you have a market rally potentially into year end doesn't mean we're out of the woods. Doesn't mean we can't go to new lows sometimes next year. But we're umpires calling balls and strikes, and you have to really pay attention to the signals that the market is sending, and it's clearly sending a pretty bullish message that probably doesn't square with what everyone's seeing with the headlines, but the reality is the market doesn't care. The market doesn't care what you think. The market doesn't care about what the media wants to cover and what numbers they want to pay attention to. The market will pay attention to the numbers that matter. Okay, and that's your job. And so that's why we look at these charts. That's why we read into these trends, because they tell you a lot about the likelihood of what's going to happen, at least in the short to medium term. Doesn't mean you're always right. Doesn't mean you're going to get it at 100% of the time, but helps put the odds in your favor. And that's why I do these videos, to try to give you a sense of the markets and try to help you put the odds in your favor. So that's it for this week. I appreciate you all tuning in. I hope you have a wonderful weekend. A reminder that the contents of this video are provided for educational purposes only. Should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.